welcome to the deep dive. Today we're digging into one of the most polarizing stories in the entire tech sector, Opendoor Technologies, ticker symbol OPEN.
That's right. And this isn't just a company facing, a tough economy.
No, not at all. They are standing at what you can only call an existential juncture. They're trying to pull off this radical reinvention right in the middle of a storm.
And that's what makes it so fascinating. Opendoor basically invented the whole iBuying model, that idea of an instant guaranteed cash offer for your home.
The dream for sellers.
Yeah,
No showings, no uncertainty.
exactly. But the relentless pressure from high interest rates and just the sheer amount of cash the original model needed has forced them into a corner.
So the central question we're tackling today, the one that everyone is asking, is this: is the current valuation just a distress signal? Is it proof that their business model is fundamentally broken?
Or is this the ground floor? Is this the entry point for one of the most significant tech turnaround stories in modern prop tech history?
And we won't make you wait 40 minutes for the bottom line. After digging through all the latest data, and it is incredibly volatile, our take is this. The market is currently paying a premium for the narrative of success. The stock is already trading slightly above its calculated intrinsic value, which tells us that all this optimism, the excitement around new leadership and AI, it's outpacing the actual verifiable results on the ground.
And our mission here is to give you that context, to give you a shortcut to being fully informed on what is, let's be honest, a very high-stakes bet. We're going way beyond the press releases.
We have to.
We're scrutinizing the whole pivot, this Opendoor 2.0. We're looking at the new aggressive management team, the stability of their balance sheet, which is critical given the losses, and we're going to establish some concrete intrinsic value ranges.
Because you can't analyze this company in a vacuum. Its fate is tied directly to the housing cycle. So we're using frameworks designed specifically for these kinds of high-variance outcomes. So to give this all some structure for you, we've broken this deep dive into two parts. In part one, we'll build the foundation. We'll start with the operational and financial bedrock. That's chapters 1 through 3, covering the business, the management, and the financial health. Part 1, chapters 1 to 3, business, management, and financials. Chapter 1, business understanding. Okay, so let's start with that foundation. Opendoor's original promise, it was incredibly powerful.
It was a game changer.
Take the agony of selling a house, which can take months, and just condense it into a few clicks and a guaranteed cash offer.
And the mechanics were, on the surface, pretty simple. They use these proprietary algorithms to value your home. They buy it directly from you for cash, do some light renovations, and then try to resell it on the open market as quickly as possible.
But that's where the problem started, right? That model, as they first built it, was intensely capital intensive.
Oh, incredibly. It required billions, with a B, in debt and equity just to hold all those houses on their balance sheet. And that's what led to this radical shift, this pivot to what they're calling Opendoor 2.0.
So what is 2.0 really?
It's a move away from being a pure capital-heavy house flipper and an attempt to transform into a capital-light software and AI-driven logistics platform.
A logistics platform. So they don't want to own the houses, they want to own the process of selling the houses.
That's the perfect way to put it. They want to be the operational efficiency layer for residential real estate.
And to really get that, you have to understand how they make money. Or maybe more importantly, how thinly they make money.
Right. It breaks down into a few key streams. The biggest line item, the one you see in the headlines, is core resale.
Okay.
So when they sell a property for, say, $400,000, that entire $400,000 is recognized as revenue. That's what led to those eye-popping, massive top-line numbers. They peaked at $15 billion annually.
But that number is so deceptive, isn't it? Because the cost of that good they sold was, $380,000.
Precisely. That huge top-line figure masks incredibly thin, almost non-existent underlying margins. The real profit potential has to come from their other revenue streams.
Which starts with the service fees.
Yes. The first is service fees. Opendoor charges sellers a fee, usually around 5% of the home's value. This is how they monetize the certainty and the convenience they offer.
And this is a critical number for their health.
It's a vital lever. That fee is a direct, high-leverage input into their contribution margin, which, as we'll see, is the real litmus test for whether this business can actually work.
And then there's the second area, the one that gets investors really excited, The ancillary services.
Yes, this is the holy grail for them. This is where the platform aims to integrate all the other services that naturally go along with a home sale. We're talking title insurance, escrow services.
Which they own, right? Through OS National.
Exactly, their own subsidiary. And also mortgage financing products. These are high-margin, software-based revenue streams. So a key metric to watch now is the attach rate.
How many customers they can convince to use these extra services.
Right. How many customers use these additional services? Because if they can sell title and a mortgage to even, say, 30% of their customers, the margins on those services are exponentially higher than any margin they could hope to make just from flipping the house itself.
That structural difference, moving from taking asset risk to selling software, that's really the core of 2.0. Which brings us to the marketplace strategy.
This might be the most strategically vital piece of the entire puzzle. The whole goal here is to decouple their revenue from the constraints of their own balance sheet.
Meaning they don't have to borrow $1 billion to make $1 billion.
You've got it. In the past, every single home they bought required them to take on more debt or use up their equity. The marketplace model flips that. It shifts Opendoor toward becoming more of a digital exchange.
So they're connecting buyers and sellers, but not taking on the inventory themselves.
Yeah. In many cases, yes. They connect sellers directly with a whole network of institutional buyers, like pension funds or REITs or even retail buyers. They might hold the house for a minimal flash period, maybe just a few hours or days, or in some cases, not at all.
And that means they can scale transaction volume.
Exponentially. Without constantly having to go back to Wall Street for billions in new financing, it turns them from a giant, slow-moving asset holder into a high-velocity transaction facilitator. It's a completely different business model.
So the engine that has to power this massive shift has to be incredibly efficient. The key to making 2.0 work isn't just the new structure, it's the technology that can drive down those operational costs.
Absolutely.
So what are the specific AI tools they're actually rolling out?
The focus is just ruthless automation to cut down on variable costs. Those are the costs tied to every single transaction, inspection, repair, closing.
The human-in-the-loop cost.
The human-in-the-loop costs, exactly. And their two big flagship tools right now are Repair Copilot and automated title workflows.
Repair Copilot sounds interesting. What does it do?
It's fascinating. It uses computer vision and machine learning that's been trained on Opendoor's decade of ground truth data, all the photos and repair invoices from every house they've ever owned.
So it's seen hundreds of thousands of broken water heaters and leaky roofs.
And it knows exactly what they cost to fix in Phoenix versus Atlanta. So it can remotely assess the condition of a home from photos and videos and estimate repair costs with, theoretically, much higher precision than a human inspector can in a quick 30-minute walkthrough.
Okay, so what is the tangible benefit of that? Because as you said, cost reduction is the absolute lifeblood of this new strategy.
The benefit is operational leverage on a scale that's hard to comprehend. They've publicly claimed they've reduced the underwriting headcount needed for each transaction from 11 people down to just 1.
11 down to 1.
11 down to 1. Through automation. I mean, just think about that. You're potentially cutting 90% of a critical operational cost. If that number is real and it holds at scale, that is not just a pivot. That is a paradigm shift in how real estate labor and efficiency works.
Wow. And it lets them process homes faster, standardize their cost estimates.
And crucially, reduce the chance of those costly appraisal errors that used to just sink their margins.
That's a massive internal shift. But it's all happening inside this historically difficult market. I mean, Opendoor is the undisputed heavyweight of iBuying now.
Well, yeah, mostly because Zillow and Redfin failed so spectacularly and just left the ring.
Right, by attrition. But their scale has just been gutted by the macro environment.
That shrink-to-survive strategy they employed was incredibly painful, but it was absolutely necessary. They had to preserve cash. In Q3 of 2025, we saw their sales just plummet to only 2,568 homes. That's a 29% drop year over year.
And more importantly, the inventory.
That's the key. They drastically cut their inventory balance. They went from a really dangerous peak of over $6 billion in homes on their balance sheet back in 2022 down to about $1.05 billion by the end of Q3 2025.
It was a deliberate, massive risk reduction exercise.
Had to be done.
And we absolutely have to talk about the huge external headwind that's hitting the entire housing world, not just Opendoor. It's this lock-in effect.
This is the single biggest macroeconomic threat they face, but it's also, weirdly, their biggest long-term opportunity.
Explain that.
Well, with the 30-year fixed mortgage rate hovering around 6.4%, you have millions of homeowners who are locked in to these amazing sub 3% rates they got during the pandemic.
My right is 2.75%. I am never moving.
You and millions of others. You can't afford to sell your current home and then buy another one at a much higher rate. It's a massive financial disincentive.
And that's caused transaction volume to just fall off a cliff.
To multi-decade lows. The data suggests that in 2025, only about 28 out of every 1,000 homes in the U.S. actually changed hands.
Wow.
That lack of inventory, that lack of transactions, it just completely starves a company like Opendoor of the velocity it needs to survive.
But you said it's also an opportunity. It's the definition of a coiled spring, isn't it?
It really is. Eventually, rates will stabilize or consumers will just get used to this as the new normal. And life happens. People get new jobs, they get married, have kids. They will be forced to move.
And when that pent-up volume finally gets released,
Opendoor will be one of the only scaled, digitized players left standing to catch it. The opportunity is just staggering.
how big are we talking?
The total addressable market, or TAM, of U.S. home sales is roughly $2 trillion a year.
$2 trillion.
Annually. Opendoor's goal is actually pretty modest in that context. They're just trying to capture 2% or 3% of that volume.
Which is still
A $40 to $60 billion annual revenue opportunity. The runway is immense, but only if they can successfully execute this pivot and survive the current freeze.
So why can't a competitor with deep pockets like Amazon or maybe a re-energized Zillow just jump back in and copy this 2.0 model? What are their competitive moats?
The barriers to entry are actually much higher now than they were 5 years ago, and it really centers on two things: data and capital access.
Let's start with data.
The data moat is key. Opendoor has over a decade of ground truth data. This isn't just public records. This is granular, specific detail on the interior condition of homes, what it actually cost to fix a furnace, local buyer preferences.
Stuff that Zillow threw away when they shut down their iBuying division.
They literally stopped collecting it. This proprietary data set, we're talking about 200 distinct data points per home, allows them to do blind valuations that are just fundamentally superior to a standard AVM like the Zestimate, which can't see inside the house.
So their advantage is literally knowing about the hidden defects and costs that are common in a specific neighborhood in a specific city.
That's exactly it. And the second moat is capital access. Opendoor already has these deep, established, asset-backed lending facilities. A new entrant trying to start up in this high-rate, risk-averse environment. It would be nearly impossible to secure the billions in revolving debt capacity you need to play at Opendoor scale, even with a capital-light model.
They proved the model is too complex for casual players.
They did. Zillow was the proof.
And then finally, there's a potential structural tailwind brewing for them: the NIR settlement.
This is a fascinating one. It could be a structural advantage worth hundreds of basis points to Opendoor's bottom line.
How so?
The settlement is completely disrupting the traditional commission structure. It's very likely going to lead to lower buyer agent commissions across the board.
Okay.
And since Opendoor, when it resells a home, almost always has to pay a buyer's agent, if that cost structurally decreases across the entire industry, let's say it goes from 2.5% down to 1.5%, that directly reduces Opendoor's cost to sell a home.
It's an immediate margin boost.
An immediate structural margin boost that they get just by being the biggest player in the market during a massive regulatory shift.
Okay, that really clarifies the high-level strategy and the world they're operating in. It is crystal clear the focus is software, not just buying more houses. Like and subscribe to Stock Analytics AI, Chapter 2, Management Evaluation. The single biggest indicator that this turnaround attempt is for real was that dramatic leadership reshuffle in late 2025.
Oh, it was a shockwave.
The board appointed Kaz Mishason, who is the former chief operating officer of Shopify, as the new CEO, replacing Carrie Wheeler.
And the signal there could not have been clearer.
It's a complete change in direction.
Completely. This company is shifting its strategic core entirely towards software architecture, platform economics, high-velocity automation, all the principles that made Shopify a monster success.
And it wasn't just bringing in an outsider. They brought the original DNA back into the building.
That's right. They called it founder-led offense. The co-founders, Keith Rabois and Eric Wu, both returned to the board, and Rabois took the chairman role.
What does that signal to you?
It signals that they're mobilizing the company's deepest roots to drive aggressive, necessary innovation. They are not going to rely on cautious, incremental change from professional managers anymore. This is a founder-led, bet the company kind of move.
And Ajay's style immediately set the new tone. It's all about a bias for speed, right?
With a bias for speed and a bias for what he calls brutal honesty. He launched dozens of new AI product tests in his first few weeks. He immediately got rid of all external consultants and demanded a return to office culture.
And that honesty is probably what investors needed most after years of just, whipsaw volatility.
Absolutely. He came right out and said that the old strategy of, and I'm quoting him, charging high spreads and hoping the macro saves us is history. It's over.
And to back that up, he set a very public, very blunt target.
Incredibly blunt. And auditable, he told investors. Opendoor aims for adjusted net income break-even by the end of 2026.
Okay, hold on. They're losing $90 million a quarter right now. They want to get to break even in about 6 quarters during a housing freeze, and they're relying on AI tools that are still in the early stages of rollout. Isn't that an almost impossibly aggressive target? I mean, is it just built to impress short-term investors, or is it a realistic operational goal?
Look, it is exceptionally aggressive, and that skepticism is completely warranted. To hit that target, it implies one of two things: either hyper-successful, flawless execution of this AI pivot, or a rapid, dramatic reversal in the housing market. Probably both.
A high-stakes bet.
It's a very high-stakes bet. But by setting such a public, audacious deadline, Najation forces a sense of urgency inside the company and, maybe more importantly, gives investors a clear, single metric to judge his performance against. It's a high-conviction approach.
And we should give credit where it's due. The prior CEO, Carrie Wheeler, she did navigate them through the absolute worst of it.
She did. She executed that necessary shrink-to-survive phase, prioritizing the balance sheet and reducing risk when the market really imploded in 2022 and 2023. She kept the ship from sinking.
So the company's capital allocation has completely followed this new strategic shift. Where is the money going now?
It's moving aggressively away from inventory expansion, that was the old model, and it's being deployed almost exclusively into high-leverage R&D.
Building the tools.
Building the tools. They're funding the development of Repair Copilot, automating their title and closing processes. The management team has recognized that the fastest way to get to profitable is to invest in the margin, not just grow the top line. Every dollar they spend on R&D that can reduce their variable cost by $2 is an investment worth making.
They also did something really unique and, frankly, pretty complex to signal their confidence. This warrant dividend. We should probably break that down carefully for everyone.
Yeah, this was a sophisticated and really fascinating piece of financial engineering. They declared a shareholder-first dividend of tradable warrants. They're called Series A, K, and Z, and they were issued to all the existing shareholders.
So what is a warrant?
You can basically think of it as a long-term call option. It gives the person holding it the right, but not the obligation, to buy a share of stock at a predetermined price sometime in the future.
So why do this instead of just a cash dividend, which they obviously can't afford?
It serves a few strategic purposes. First, it's a sweetener. It's a reward for the long-term holders who stuck with the company and suffered through the stock's big decline. It's like a loyalty bonus that gives them free upside exposure.
And the second reason is even more important.
The second, and the crucial reason, is that it's a mechanism to raise capital down the road. If the stock does recover and appreciate significantly, and those warrants become profitable to exercise, the company gets a direct injection of fresh cash from its most loyal shareholders.
And they don't have to go through expensive external financing or dilute everyone at the current low prices.
Exactly. It's a very public, very strong signal that management has extremely high conviction in this turnaround, and they fully expect the stock to recover, and quickly.
Speaking of high conviction, the insider activity has been just overwhelmingly bullish. You mentioned co-founder Eric Wu.
He participated in a $40 million private placement, a PIPE, alongside the venture capital firm Kusla Ventures.
That is about the most powerful signal an investor can get, isn't it?
It is. An insider committing $40 million of fresh personal capital, not just holding on to old shares, but actively buying new ones at this critical stage. That is a massive, undeniable vote of confidence in the turnaround plan and in the new CEO. It screams that the founders believe the stock is deeply undervalued.
But, Knowing how public Nugation has been about his intention to ruin the night of short sellers, do you think that $40 million PIPE is also partly a PR move? Is it designed to help trigger a short squeeze, given how high the short interest is?
That's a fair and critical question. There is absolutely a strategic element of psychological warfare going on here. The PIPE ensures that the long-term holders, like the founders and Khosla, are all aligned and have fresh skin in the game.
And it sends a message.
And yes, demonstrating that kind of high internal conviction so publicly and so substantially is guaranteed to put immense pressure on the short sellers who are betting against the company's survival. It's a two-pronged attack: fund the company's operations and at the same time put fear into the hearts of your detractors.
Okay, finally on management, let's touch on return on invested capital, or ROIC. It's still persistently negative, which is always tough to see for a supposed growth company.
It is, and ROIC is suffering right now because the asset-heavy nature of owning all those homes means the invested capital part of the equation, the denominator, is just enormous.
And the 2.0 pivot is designed to fix that.
Explicitly, they have to do two things. One, increase turnover velocity to generate more gross profit for every dollar of capital they invest. And two, use those off-balance sheet marketplace transactions, which directly reduce the amount of invested capital needed for each transaction. That should structurally improve ROIC over time, but right now, that negative number just reflects the deep asset-heavy hole they're still climbing out of. If you are looking for this level of detail on other companies in your portfolio, we have a deal for you. For $4.99 9-month, get 500+ deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
Remember, members can add stock suggestions for future videos in the comments, and we will pick them up. Chapter 3, Financial Health.
Okay, now let's get into the cold, hard numbers. We know Opendoor's revenue has been a massive roller coaster. It exploded during the housing boom and then just contracted sharply during this freeze. Let's look at the hard data from Q3 2025.
Yeah, the Q3 data really confirms how severe that contraction was. Revenue came in at $915 million.
Which is a sharp drop. A very sharp 34% decrease year over year. Now, this wasn't a surprise. It reflects that deliberate shrink-to-survive strategy to get risk off the books, but it really highlights the struggle they're having to maintain any kind of scale when they're actively trying to liquidate inventory.
And you can contrast that starkly with a rival like Zillow. They reported revenue growth of 16% in the same quarter.
And that just proves the fundamental difference between a tech-enabled media and listed model versus an inventory-constrained transactional model. They are two very different businesses.
The top line decline is one thing, but the real red flag, the thing that keeps people up at night, is the margin crisis. This is the #1 area of concern, and it's the entire focus of the 2.0 pivot.
It is. Gross margin in Q3 was 7.2%, which is low for any kind of retailer. But the metric that truly matters, the critical one, is the contribution margin.
And what was that figure?
It fell significantly. It was a mere 2.2%, down from 3.8% the year before.
2.2%. To put that into perspective for everyone listening, what does a 2.2% contribution margin actually mean, and why is that so dangerous?
Okay, so contribution margin is the revenue you have left over after you pay for all the direct costs of that one specific house flip.
So the acquisition fees, holding costs.
Holding costs like property taxes and the interest on the debt, selling commissions, and critically, the cost of all the repairs and renovations. A 2.2% CM means that for every $100,000 house they sell, they only keep $2,200 to cover all their massive corporate overhead.
All the salaries, the R&D, marketing, the CEO's office.
Everything. There is virtually zero cushion for error.
Zero.
If their average repair estimate is off by just 0.5%, if they thought a roof repair would cost $5,000, but it actually costs $5,500, the entire profit margin for that transaction and potentially for the whole quarter's operations could just evaporate.
They're operating that close to the edge.
Dangerously close to unit economic insolvency. And that low CM is the direct reason why their GAAP net loss for Q3 widened to a loss of $90 million. They are losing roughly 10 cents for every single dollar of revenue they generate, which just reinforces how urgent this 2.0 AI overhaul really is.
Okay, so let's talk financial stability. Because a $90 million loss quarter after quarter sounds like an existential risk. But their debt structure, that gives them a crucial buffer, right?
It does, and this is why it's so important to distinguish between the different types of debt they have. Opendoor holds roughly $1.2 billion in asset-backed debt. And crucially, this debt is mostly non-recourse to the parent company.
Explain non-recourse simply. Why does that matter so much for the parent company's survival?
Think of it like a specialized mortgage that's only tied to the inventory, to the houses themselves.
Yeah.
If the housing market crashes and a home securing that debt loses value, the lenders take the loss on that specific asset. They cannot come after the parent company's cash reserves, its R&D budget, or any of its other core assets.
It firewalls the core business from the housing inventory.
Exactly. It protects the company's operational integrity from an immediate housing market collapse. And that structure, along with their inventory being classified as current assets, gives them the liquidity buffer they need to weather this turnaround phase.
So when we try to value the company, the price-to-earnings ratio is totally useless. They have no earnings.
Yeah.
We have to look at price to sales.
Correct. Their market cap has been fluctuating in that $5.2 to $7.3 billion range. With shrinking trailing revenue, their PS ratio is sitting at roughly 1.3x.
How does that compare?
Well, compared to traditional homebuilders who often trade closer to 1x sales, Opendoor is trading at a slight premium. And that premium is the market explicitly giving them credit for that potential high-growth tech platform upside. They're not pricing it like a low-margin construction company.
And to get to a real intrinsic value, we use a discounted cash flow, or DCF, model. The idea is to project their future cash flows and then discount them back to what they're worth today. But why is a DCF for Opendoor so sensitive and volatile right now?
Because the entire output of the model hinges almost completely on whether or not they succeed with those 2026 turnaround assumptions. If Najation hits his breaking target and they get margin expansion, the value explodes higher. If he misses, the value implodes. So we ran 3 different scenarios to capture that extreme variance.
Okay, walk us through those actionable value ranges.
The bear case assumes the pivot fails. Margins stay stuck at that terrible 2–3% level, and revenue keeps contracting because of the lock-in effect. In that world, the intrinsic value is little more than what the assets are worth in a liquidation. It puts the stock at $1.50 to $2.50.
Nightmare scenario.
The nightmare scenario. Then you have the base case. This assumes they stabilize. Management executes the initial plan. Growth comes back modestly, maybe 10%, and contribution margins get to a viable 4–5%. This gives us an estimated share value of $5.50 to $7.
Okay, and the high stakes, everything goes right outcome.
The bull case. This assumes Opendoor 2.0 is a massive success. The AI automation drives huge efficiencies, the marketplace model scales dramatically, and their contribution margins hit a true software-like 6–7%. In that scenario, the share value could reach $10 to $14.
So the really key insight here is that the current trading price, which has been hovering around $7.66, is already at the upper end of that base case. It's even poking into the low end of the bull case.
Precisely. The market is not waiting for proof. It is pricing in the initial successful execution of the turnaround. It's giving full credit to the new management team and the power of this new narrative.
What are the key numbers powering that optimism in the DCF model?
The inputs have to be aggressive to get there. We're projecting revenue growth to rebound sharply. After a negative 18% decline in 2025, the model forecasts a jump to plus 17% growth in 2026.
That's a huge swing.
A huge swing. And for the discount rate, the weighted average cost of capital, or WACC, is estimated pretty conservatively at 7.5% to 8.5%. That rate reflects the company's extreme volatility. You can see that in its high beta of 2.4 to 3.59. But it's moderated a bit because of the lower cost of their asset-backed debt. They have cheap access to inventory finance, even if their equity is a roller coaster.
That brings us to our mid-episode break. If you are looking for this level of detail on other companies in your portfolio, we have a deal for you. For $4.99 a month, get 500-plus deep-dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives. Like and subscribe to Stock Analytic AI. When we return, we'll move beyond the core financials to discuss the dynamics that are driving the stock price right now. Market sentiment, the quantitative funds betting on volatility, and the acute risks facing Opendoor. Part 2. Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment.
So if you were to look strictly at that 2.2% contribution margin, you would assume the stock should be trading much, much lower. And that's why we see this huge disconnect among institutional analysts.
Right.
The bearish targets from some of the legacy firms have been stuck as low as $1.40 or $2 a share. They're just reflecting the cash burn history and the macro pressure.
Yet the stock is trading around $7.66.
Yeah.
Which means it has blown past almost every single one of those bear targets. It just confirms what we said earlier.
Yeah.
The stock is trading on momentum, it's trading on technical signals, and above all, it's trading on the turnaround narrative.
And that narrative has been dramatically amplified by the shift in the media tone. A year ago, the headlines were all grim. It was Opendoor is dying. iBuying is a failed
I
model.
remember those.
Now, after Najatian's appointment and the founders coming back, the story has done a complete 180. It's all high risk, high reward AI play. That found mode story is dominating news cycle, and it's successfully overshadowing those weak Q3 financials we just broke down.
And that optimistic narrative has collided head-on with all that institutional skepticism, and it's created this highly combustible trading environment, this short squeeze dynamic.
It's incredibly volatile. The short interest is extremely high right now. It's sitting somewhere between 24% and 27% of the total tradable float.
A quarter of the float is betting against it.
A quarter of the float is a massive institutional bet that this turnaround is going to fail and the company will fall back to its liquidation value.
So how does that huge percentage act as a coiled spring, as you put it before?
Well, that huge mass of short bets creates a guaranteed forced buying pressure if any positive news comes out. If the company announces one small operational win, or if a major analyst upgrades the stock, all those short sellers are forced to rush in to cover their positions.
They have to buy shares to close their bet.
They have to buy shares, and they have to do it quickly,
Yeah.
which drives the price up exponentially higher than the news itself might fundamentally justify. That big rally we saw in November 2025, where the stock jumped over 20% in just a few days, that was partly, if not mostly, attributed to this short covering dynamic. And the CEO knows this. He's openly admitted his intention is to ruin the night of the short sellers with his aggressive strategy. He is weaponizing the short interest against them.
And the technical signals, the charts, they all confirm this bullish breakout that followed that rally.
They do. The stock is trading significantly above both its 50-day moving average and, critically, its 200-day moving average. That 200-day was lingering down around $3.29 earlier in the year.
And crossing that is a big deal for traders.
It's a powerful signal. Technical traders interpret that as the potential end of a long, painful bear market and the beginning of a new uptrend, regardless of what the underlying 2.2% contribution margin data says. It becomes a psychological and algorithmic signal that just self-reinforces the momentum.
Chapter 5. Ownership structure.
The shareholder base really reflects this ongoing conflict and the turnaround narrative perfectly. We've seen a pretty significant institutional rotation. On one hand, you have stability from passive funds like Vanguard. They remain the largest shareholder, but that's just because their mandate is to track the index.
But the more interesting story is this smart money pivot we saw in the last quarter. Which of the big players are getting involved now?
The sophisticated quantitative funds, the algorithms, have been aggressively increasing their positions. Jane Street upped its position by over 23 million shares. And Renaissance Technologies, RenTech, which is famous for being one of the most successful hedge funds in history, added over 17 million shares.
What does that tell you?
It suggests that their complex, high-speed algorithmic models have detected something. It could be a fundamental bottoming of the business cycle, but more likely it's a volatility arbitrage opportunity. They see the CEO change, they see the high short interest, and they're betting on big price movement, not necessarily just on long-term value.
And on the other side of that trade, you see the traditional active managers heading for the exits.
Exactly. Traditional active managers like T. Rowe Price and Two Sigma, they significantly reduced or completely exited their positions. It looks like they capitulated right before the turnaround narrative really took hold and the stock started to rally.
So you have a rotation from cautious fundamental managers to these volatility-seeking quant funds.
And that's a defining characteristic of these high-risk, high-reward turnaround plays like Opendoor.
Yeah, we just have to reiterate the importance of that insider confidence signal, specifically Eric Wu's PE investment.
It is the strongest internal signal you can possibly have. Eric Wu's $40 million private placement alongside Khosla Ventures is a hard commitment of personal capital. You couple that with the open market purchases by the company's president, Sri Radhakrishna, and you have this compelling internal evidence that management is genuinely all in on this recovery. It's a powerful counter-narrative to all those short sellers.
And this combination of forces, it creates a really fascinating ownership dynamic, doesn't it?
It creates a volatile battleground. The top institutions control about 40% of the float. When you factor in that 25% short interest, you realize the market is just dominated by this conflict between the powerful quant and founder long block and the aggressive hedge fund short block.
And that conflict is what fuels those explosive price moves we've been seeing.
Absolutely. A small move in the share price creates a huge financial impact for both sides, so every tick matters.
Chapter 6, Risk Assessment.
All right, before we get to our final conclusion, let's explicitly run through the internal and external factors that could either make that bull case a reality or trigger the bear case.
Let's start with their internal strengths. What are the assets they can leverage right now?
Their number one strength remains that proprietary data moat. That decade of ground truth data on inspections and repair costs, you just can't replicate that overnight. Second is their unique tech infrastructure, especially that ability to do an initial 10-minute remote pricing assessment. That's a powerful tool for scaling. And third, they have those established non-recourse credit facilities, which gives them liquidity access that new competitors just don't have.
But those strengths are up against some pretty profound weaknesses that they still haven't fully solved.
And the primary weakness is still the structural problem of their thin unit economics. I mean, we can't stress this enough. That 2.2% contribution margin leaves almost no room for any error. A small market delay, a minor renovation cost overrun, a sudden spike in carrying costs, any of it can instantly wipe out the profit on a home.
And they still have inventory risk.
They still carry about $1 billion in inventory risk on the balance sheet. And while that's mitigated by the non-recourse debt, it still exposes them to massive markdowns if the housing market were to fall quickly. And finally, you have the historical brand trust issues. There have been seller complaints about final offers being adjusted late in the process. That's a headwind they have to overcome to acquire customers cheaply.
But if they do execute 2.0 successfully, the opportunities are these high multiple levers that could completely re-rate the stock.
Absolutely. The highest multiple opportunity is without a doubt the marketplace model. If they can successfully decouple their revenue from their capital risk, the market will stop pricing them like a capital-heavy bank and start re-rating them as a true tech platform. That means PS multiples you see in high-growth software companies.
And they could also monetize the AI itself.
That's the other big opportunity, the potential for AI monetization. They could license their proprietary valuation or their repair estimation tools to third parties, like banks or insurance companies. That would create a high-margin, pure SaaS revenue stream, which would fundamentally change their entire margin profile overnight.
Okay, now for the major external threats. Let's start with the big one, the macro factor.
High interest rates. It's that simple. Mortgage rates that remain stubbornly above 6% are the single biggest threat. It crushes buyer demand, it prevents that coiled spring from releasing, and it increases Opendoor's own cost of carrying inventory, even with the non-recourse debt. If this higher-for-longer rate policy persists for another few years, Opendoor might simply burn through its cash runway before the market ever recovers.
But there is a more acute, more specific threat that hits their already razor-thin contribution margin directly. That's the 2025 tariffs on construction materials.
This is a critical operational risk that's very specific to a house flipper's business model. There are proposed and enacted U.S. tariffs on imported materials, softwood lumber, steel, certain composite products, and they directly increase the cost of renovations and repairs.
By how much?
Industry experts estimate that these tariffs could raise material costs by somewhere between 4% and 10% for a typical project. That could add upwards of $9,000 to the cost of renovating a median-priced home.
Why is that an acute threat for Opendoor versus, say, a traditional home builder?
Because of that 2.2% contribution margin, a traditional home builder might have higher margins or they can adjust their sourcing months in advance. But for Opendoor, which relies on quick, efficient renovations to keep their holding costs low, a sudden mandatory spike of $9,000 in material costs directly eats away at that tiny 2.2% margin. It could instantly turn what was a marginally profitable flip into a guaranteed loss. It's a risk they really can't hedge easily.
Chapter 7. Conclusion. Okay, let's bring this all together. Let's synthesize this entire deep dive. The AI pivot, the aggressive new management, the massive short interest, and all those external risks into the definitive bull and bear cases for Opendoor.
The bull case is the full realization of that Amazon of real estate vision, and it's all powered by automation. It relies on CEO Najation's successfully executing this 2.0 overhaul. He has to prove that iBuying's original sin wasn't the model itself, but just the lack of automation.
And as the AI scales?
As the AI tools scale, their fixed costs drop. The marketplace model gains traction, and they achieve true economies of scale. Then, when interest rates finally stabilize, that pent-up housing volume floods the market. And Opendoor, as the last scaled player standing, captures that volume and the stock re-rates toward our bull case intrinsic value range of $12 to $14 plus 8.
And firstly, the bear case.
The bear case rests on the idea that residential real estate is just fundamentally too bespoke, too idiosyncratic for algorithms. The AI tools fail to spot critical structural problems in a house. The 2025 tariffs completely crushed their already thin margins, and transaction volume just stays muted because of persistent high rates.
And they just burn through cash.
The cash burn continues. It forces massive dilution or even a restructuring, and that drives the stock right back down towards liquidation value of $1.50 to $2.50.
So let's summarize the valuation.
To summarize our intrinsic valuation, our base case estimated value range is $5.50 to $7 per share. With the current trading price around $7.66, Opendoor is trading slightly above this intrinsic range. That means investors are already paying up for the anticipated success.
So what is the final outlook? What should an investor do if they're considering this high-stakes, highly volatile stock?
Our final conclusion is a neutral, cautious hold. The company is essentially a high-variance option on the successful execution of 2.0 and the eventual recovery of the housing market. The current price is paying a premium for the turnaround narrative, and that's being fueled by the new CEO and the short squeeze dynamic.
So wait for a better entry point or more proof?
A prudent value strategy would suggest waiting for one of two things. Either a pullback in the stock price toward that $5.56 range to enter at the base case valuation, or, and this is critical, concrete, irrefutable evidence of margin expansion. Specifically, you need to see that contribution margins stabilize above 4%. That margin proof is the only thing that can truly validate the current valuation.
That is a fantastic breakdown of a fascinating bet. Opendoor is really trying to prove that their core business model wasn't flawed, it was just under-automated. If this AI overhaul actually works, this becomes a technology company whose competitive moat is measured in deep, proprietary data about houses, not just in lines of code. The execution risk is massive, but the upside, if they succeed, is immense. What part of this operational shift are you watching most closely? If you want more deep dives like this, be sure to like and subscribe to Stock Analytics AI. And for even more in-depth analysis and custom research, remember, for $4.99 fund, get 500-plus deep dive videos on all S&P 500 stocks with NASDAQ 100 coming next, plus members-only requested deep dives.
This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.